This is Chapter 2 of the 2008 market crash, and in this chapter we will discuss about the background and causes of the crash. The 2008 market crash was caused by a combination of factors that created a perfect storm in the housing and financial markets. Some of the key causes include subprime mortgages. The subprime mortgages that contributed to the 2008 market crash were characterized by low initial interest rates that adjusted upward over time, making them unaffordable for many borrowers. These loans, often referred to as subprime adjustable rate mortgages, ARMs, were typically offered to borrowers with poor credit who might not have qualified for a traditional mortgage. In the years leading up to the crash, there was a large increase in the number of subprime mortgages being issued. This was driven by a combination of factors including a lack of regulation in the housing market, financial innovation that made it easy to package and resell. Lack of regulation. A lack of regulation in the housing and mortgage market was a significant contributing factor to the 2008 market crash. Prior to the crash, there were few regulations in place to ensure that lenders were making responsible loans, and as a result, many risky lending practices went unchecked. One example of this was the proliferation of subprime mortgages, which were offered to borrowers with poor credit and little documentation of their income or assets. These loans were often characterized by low initial interest rates that adjusted upward over time, making them unaffordable for many borrowers. Another example of lack of regulation was the lack of oversight over the financial institutions that created and sold mortgage-backed securities and collateralized debt obligations. These securities were composed of pools of mortgages, including subprime mortgages, and were sold to investors as a way to spread risk. However, because of the complex nature of these securities and the lack of transparency in their underlying assets, many investors were not aware of the risks they were taking on. Additionally, the rating agencies which were supposed to evaluate the risk of these securities failed to do so accurately, as they were paid by the issuers of the securities, creating a conflict of interest. This lack of regulation allowed the housing market to become overheated and created a situation where many borrowers and investors were taking on more risk than they were aware of. When the housing market began to decline, this led to a large number of defaults and foreclosures, which in turn led to a decline in housing prices and caused a domino effect of failures in financial institutions around the world, ultimately leading to the 2008 market crash. Complex financial instruments. Complex financial instruments, such as mortgage-backed securities and collateralized debt obligations, CDOs, played a significant role in the 2008 market crash. These securities were created by bundling together large numbers of mortgages, including subprime mortgages, and then selling them to investors as a way to spread risk. Mortgage-backed securities, MBS, are securities that represent an ownership interest in a pool of mortgages. These securities were created by financial institutions, such as banks and investment firms, which bought mortgages from lenders and then packaged them together into securities that could be sold to investors. Collateralized debt obligations, CDOs, are securities that are created by pooling together multiple debt obligations, such as mortgages and credit card debt. These securities were then sliced into tranches, or different layers of risk, and sold to investors. The problem with these securities was that they were often very complex and difficult for investors to understand, and the underlying assets, the mortgages, were not transparent. Additionally, the rating agencies which were supposed to evaluate the risk of these securities failed to do so accurately, as they were paid by the issuers of the securities, creating a conflict of interest. When the housing market began to decline and interest rates increased, many of the subprime mortgages underlying these securities began to default. This led to significant losses for the financial institutions that held these securities and for the investors who owned them. This ultimately led to a chain reaction of failures in the banking and financial sectors, which triggered the 2008 market crash. Timeline leading up to the 2008 crash. The timeline leading up to the 2008 market crash can be broken down into several key events. Early 2000s, the U.S. housing market begins to experience a rapid increase in prices, driven in part by a lack of regulation in the mortgage market and the widespread availability of subprime mortgages. 2005, the Federal Reserve begins to raise interest rates, making it more difficult for many subprime borrowers to afford their adjustable-rate mortgages. 2006, the number of defaults and foreclosures on subprime mortgages begins to increase, leading to a decline in housing prices. 2007, many large financial institutions begin to report significant losses related to their investments in subprime mortgages. 2008, the crisis reaches a boiling point as several major investment banks and mortgage lenders fail, leading to a global financial panic. September 2008, the investment bank Lehman Brothers, one of the largest players in the subprime mortgage market, files for bankruptcy, triggering a global financial crisis. October 2008, the U.S. government passes the Emergency Economic Stabilization Act, which includes the creation of the Troubled Asset Relief Program, TARP, to provide financial assistance to struggling banks. November 2008, the Federal Reserve announces a program to purchase up to $600 billion in mortgage-backed securities in an effort to stabilize the housing market. 2009, the global economy enters into a severe recession, with many countries experiencing high levels of unemployment and debt. This timeline shows how the lack of regulation, the proliferation of risky lending practices and complex financial instruments, coupled with economic conditions, created a perfect storm that led to the 2008 market crash. This was Chapter 2. In Chapter 3 we will discuss about the impact of the 2008 market crash. If you liked the video, do consider giving it a like and subscribe to the Innovage Media channel for more such contents.